Now let's understand what are the different types of investors. The first category of investor is passive investors. By passive investor, we mean everyone who invests through stock exchanges or the people who deal in the marketable securities or maybe IPO, that is primary market. Each one of us will be falling into the category of passive investors, where you invest in stock or other assets and you decide on the or you basis your requirement of the investment payoff that will be getting in future. You decide your investment, right? And then there's a strategy. What is the strategy for the passive investors? You need to identify the particular asset which is mispriced according to your calculation, or the intrinsic value of that particular asset, let's say, is 1000, and if the asset right now is trading at 800, definitely you should go ahead and buy those investments for future. The second category would be active investors who invest in the company and then change the way the company works. For example, venture capitalist. Now, whenever a company starts, the first funding is done by the proprietor or the founders of the company. The second level of funding is done by the venture capitalist. The third level of funding is done by let's say private equity firms. And if the company becomes substantially large and it wants to expand more, they try to go for listing their shares on stock exchanges. So, but before that, they issue their IPO, where people, small investors, big investors, everyone invests in their company and they get the huge fund to expand their business and take it to the next level. But the first level, where we have the funding from the external parties, is your venture capitalist. So they will be known as active investors. Now here are some investing tips for you. If you are investing for long term, your tip should be that figure out a company which is fundamentally good but has been neglected. Maybe the major investors who are investing on the psychological factors rather than technical factors. So you need to identify a company which has been neglected but is fundamentally very strong. So you should choose that company and you should keep the investment there, so that it gives you a substantially higher return in future than what you are getting or you'll be getting from the company right now. That's the tip when you are trying to make the investment for long term period. In case you are investing for short term period, when the company announced bad earnings, right, you know that the company is good but it has announced the bad earning, the market reacts and the prices start falling. So let's say tomorrow, if the IT companies or one of the IT companies is not doing good and the prices of that particular IT company starts falling, and you know that the company is fundamentally very strong and will recover in some time, or maybe there is some problem in the management due to which the market is reacting, but the fundamental of the company is very strong so that it can recover itself. In that case, you should wait for the prices to fall, and then you should buy those shares at that time when the prices have fall. When the company has fixed itself and the prices of the shares are increasing, you can go ahead and sell those shares and make a good or huge profit. So right things to do as an investor. First thing is, you need to understand what is the risk associated with that particular stock and what is the valuation of the asset. That's why I'm continuously saying, please calculate the intrinsic value of the asset, and then you calculate the beta of the asset, which is your risk. We'll be seeing those topics when we cover a separate video on the technical analysis and fundamental analysis of stocks. Then you need to understand how the market is reacting and what are the breaking points. Let's say I design a particular range within which the prices of the particular stock will be going up or going down. So you know when you have to sell and you should know when you have to buy. So if you are smart enough to realize this, how the market is behaving and what are the breaking points, this would be most appropriate thing for you to do. So, as a homework as an investor or portfolio manager, it should be that you do your proper research about the asset where you are planning to invest, and you should be designing these strategies. Maybe you need to hold on for some time before you make the investment, or maybe you need to hold on for some time before you sell that particular investment. So all these strategies should be there in your mind through the thorough research, and based on your research and understanding the market, how it behaves, you should make your investment decisions.